So just let's get some terminology out of the way. Who is a lessor? The one which is giving the asset, right? Who is the lessee? This is the one taking the asset. And the lessor allows the lessee to use the asset for a predetermined period, and they agree to, the lessee of course agrees to make periodic payments to the lessor for that period during which they are getting the right to use the asset, and it can be as long as 20 years or as short as a month. Right. Now, if you talk about the advantages of leasing, well, of course, you don't need to buy the asset up front, so less cash is needed. Sometimes, with little to no down payment, you can get the asset. And because, from the lessor's perspective or the party giving the asset's perspective, the asset is the collateral itself, right? So, it is a secured borrowing and a secured lending, because there is an asset as safety or collateral that can be sold and the money returned, or the asset itself returned to the lessor in case there is a default by the lessee, that they are not able to pay their payments on time. So therefore, the interest rate that they charge is also low. And as far as the lessee is concerned, that they have no commitment, they can return the asset whenever they want. So it's a lower risk for the lessee, because if the equipment becomes obsolete, it's not their problem because it's not under their ownership. They can just stop making the payments and return the asset to the lessor. Now, if you are the lessee, you have a choice of classifying this lease as a operating lease or financing lease. Of course, that is subject to a certain criteria, and we will be discussing what that criteria is shortly. But technically speaking, a finance lease is similar to purchasing the asset. So like how we were talking about that you don't have the risk of obsolescence because you're just renting it, right? And you're not getting the ownership is with the lessor. So that is true to quite an extent for an operating lease, because in an operating lease you're genuinely just renting the asset. But when we talk about a financial lease, right, you really need to check the terms and conditions of the lease, that are you getting the ownership or not. As a lessee, is the ownership being transferred to you, and what happens if the value of the asset drops? Can you just return the asset and make no more payments, or that liability is something that you have to settle in cash and you cannot return the asset? So that of course depends on the terms and conditions of the lease. But when we talk about the technical aspect, of course a finance lease is more close to purchasing the asset, right, taking ownership of the asset, but paying in installments over a number of years or months, or depending on the duration. But an operating lease is definitely similar to renting. So this is the main difference between a finance lease and operating lease. However, earlier we were allowed to rent an asset or take it on operating lease without recording the asset on our balance sheet and the liability on our balance sheet, but that is not allowed anymore. Right. So what if you decide to declare every lease that you're having as an operating lease? Will that be allowed? The answer is no. If these conditions are met, any one of these following conditions is met, then you have to classify it as a finance lease. Now, if the ownership will be transferred to you, not at the beginning, not at the end, not in the middle, but any time, if the ownership is transferring to the lessee, that means this is not an operating lease, this is a finance lease, right? If the lessee has an option to purchase, then it becomes a finance lease as well, right? If it is reasonably certain that it will do so. And in a lot of these contracts, which are called let to buy and similar situations, where the underlying assumption is that they are going to buy, so that is also definitely going to be considered a financial lease. If you're leasing the asset for a major part of its useful life, then again it becomes a finance lease. Or if the present value of the sum of the lease payments equals to or exceeds the fair value of the asset, then again it is going to be a financial lease. And especially if the asset is very, very specific for the lessor, as in it is only for use of the lessee, right? The lessor cannot use it elsewhere, then definitely this is going to be treated as a finance lease because the lessor has no other use for it. If none of these criteria are met, then you can go ahead and record it as an operating lease. Right, but even if you are going to record it as an operating lease, it's not that you can get away with not recording anything on the balance sheet. That, of course, is not possible anymore. Right, so now how would you go about recording this financial lease or operating lease? First of all, it depends whether it is classified as financial or operating. Secondly, it depends whether you are reporting under US GAAP or IFRS. And of course, it depends on whether you are the lessor or the lessee. Then we're going to discuss each one of those, right? So let's make a chart. First of all, are you the lessor or the lessee, right? And if you are the lessor, at least the good news is that there is no difference in IFRS or US GAAP accounting for lessors. But for lessee, there is a difference over here. So if you are reporting under US GAAP or if you are reporting under IFRS, there will be different accounting here. And for within each of these, it is going to depend whether if you are declaring it as an operating lease or financing lease. For US GAAP, it depends on whether you are operating lease or financial lease. The good news is IFRS has a single accounting model for both operating and financial, right? But US GAAP has a different model for operating lease and different model for financial lease for lessee. And for lessor, both IFRS and US GAAP have different models for operating lease and financial lease, but at least their treatment is the same in both cases. So for lessor, we don't need to worry whether it is IFRS or US GAAP. We just need to worry whether it's operating lease or financial lease. But for lessee, we need to first check whether it's US GAAP or IFRS, and then within US GAAP, it makes a difference whether it's operating lease or financial lease. But in IFRS, it doesn't matter. We will be looking at each of these separately now. So let's get started. First for lessee and for IFRS, right? Which is this part over here, lessee and IFRS. So we'll be starting off from here. As I told you, they have the same one for operating and financial lease, so no need for that difference over here. Whether it is operating lease or financial lease, it is going to be the same treatment. Now, what is that treatment? When you will take that asset on lease, you're going to record a liability and you're going to record an asset. Now, even though technically it is an operating lease even, right? You're taking something on rent. Why do you need to record a liability? Well, because I explained to you that companies would misuse this operating lease option and they would take off balance sheet financing, right? So to prevent that, now IFRS, as per IFRS 6 standard 16, requires you to record an asset and a liability. Now, how do you go about doing that? First of all, you need to know what is the present value of lease payments. Now, what does that mean? Let's say you're going to be paying 100,000 every year for 5 years, right? So you need to take the present value of those. So you'll take the discounted value, right, for each of those, and let's say n, depending on whatever is the number of periods. So you will discount these back and calculate the present value. And that present value is what goes here in the liability. Let's say that is 379092. Just taking an example, right? If this is for a 5-year amount, so 100,000, and then for 1 year, and then 2 years, and then 3 years, at let's say R is equal to 10%. So this comes to around, let's say, 379092. That is the present value of the lease payments, which you as a company, as the lessee, are agreeing to pay. So this is your liability, and it is obviously taken after the discounting. So this is the present value of these 100,000 into 5 payments that you have agreed to make, right? And you will record an asset because, of course, the balance sheet has to remain balanced. So you will record a right of use equal to this exact same amount. This is how the accounting is done for lessee, whether it is operating lease or financial lease. Right. Now, what happens in each subsequent period? So, this $100,000 that you're paying every year, let's say for your lease payment, part of that is your interest expense, right? Now, how much is that interest expense? You need to know the interest rate. You need to know what is the amount of liability that you recorded, right? So 10%, let's say, is the interest rate, and this is the amount of liability you recorded. So 10% of that, which will be approximately 37909, right? 0.2. That is going to be your interest expense. So if you take your lease payment and you minus from it your interest expense, you will get your principal that you're paying. So that will be around somewhere around 62,000, right? So how did we get the interest expense? We took the lease liability and we multiplied it with whatever is the rate, and we got our interest expense. And then we took that interest expense, subtracted it from the lease payment, and we got the principal repayment. So what's going to happen on your balance sheet, that here you have your asset, your right of use, and here you have your liability, which is your lease liability, right? And the principal payment, the principal repayment is what is going to reduce your lease liability. So whenever you make a lease payment, part of that is going to be treated as interest expense, depending on what was the lease liability recorded at the time, what is the discount rate. So part of that is going to be interest expense, and the remaining portion, which was 62,000 something, is going to be the reduction in your lease liability. And as far as your return on asset is concerned, that is also going to be reduced, but that reduction is going to be called amortization of this intangible asset, which is your right of use. And this amortization is done on a straight line basis over the lease term. Now this is confusing, so please be very careful. 379092 is the asset you recorded, 379092 is the liability you recorded, and you're going to be reducing them both. But as you might remember from our discussion in quants, that what happens is initially the interest portion will be high because it is applied to this larger base, and the principal repayment portion of that 100,000 payment that you are making, the principal payment portion will be low. But as the outstanding amount goes down, the principal portion becomes high. So if you talk about your principal repayment, it increases, right? The principal portion increases with time. And if you talk about your outstanding liability, it decreases at an exponential rate. So what I'm trying to tell you is that the principal portion is lower initially, right? And higher later. Let's say the percentage is fixed, so the amount of interest will be going down. The principal amount will be more from this fixed payment that you're giving, and therefore initially the payment portion will be lower going to principal, and later it will be higher going to principal. But if you're doing amortization on a straight line basis, it's going to be equally divided across, let's say it's a 5-year period or 10-year period or whatever is the life. So initially your amortization will be higher, right? Initially your amortization will be higher and your principal will be lower. That means your liability will be going down this will be going down slowly, and this will be going down faster initially. Later on, obviously, the principal portion will catch up, and then this will start going down very fast in the later years. Eventually, of course, both of them are going to be equal because the value on the asset side is exactly the same as the value on the liability side, which is recorded, and they both go to zero. But the point is that it's just a timing difference. And because of this timing difference, what could happen in lessee accounting in IFRS is that there could be some divergence in the value of the lease liability and the right of use of an asset. Right. So, what is the effect on your financial statements? Balance sheet, lease liability is reported, and right of use of an asset is reported, and this is obviously reported net of accumulated amortization, so it is reduced based on the amortization, and the liability is reduced as the principal repayments are made. On the income statement, you have two expenses shown separately. This is very important. Think of your income statement. So you have your sales, your cost of sales, then you have your gross profit, right? And then your selling, general, and administrative expenses. Then you have your operating profit or EBIT, right? And then you have your interest expense. So part of that 100,000 that you're paying is going towards interest, and part of that is going towards principal repayment, right? And as far as your expense is concerned, you're going to be recording interest expense, and you're going to be recording not a principal repayment expense, but you will be recording an amortization of the right of use. And this is what we discussed, that that amount might be higher than the principal repayment portion. So that difference is going to be hitting your profitability, because if you're recording a higher amount of amortization, and that might be going in your cost of sales if it's related to production, right? So you might be recording like a 67,000 amortization expense over here and a 37,000 interest expense. So since this whole thing is recorded in a split, it's going to impact your ratios, right? So if I just look at my gross profit, it's going to be different compared to if, let's say, the entire expense of 100,000 was being recorded as an operating lease payment in my cost of sales for my manufacturing equipment, right? So it definitely makes a difference how you record that 100,000, and whether you're recording it exactly the same or there's a different amount being recorded. So if your initial years you're having a higher amortization, and then later you're having a lower amortization, but the principal amount will be higher later. So eventually, of course, both the lease liability and asset will be completely brought to zero, but the timing difference could be there. And all of these things, they make a difference, right? They make a difference to your ratio analysis and your profitability if you're looking at gross profitability or operating profit, because interest being charged before and after makes a difference. And then you've got your cash flow statement, which means that if we were treating it as a operating lease, then those payments would be showing up in operating cash flows, right? But if we are now breaking it up into your amortization and your interest expense, then definitely the principal component which is being paid will be shown. So this part, which is the 62,000, is going to be shown under financing activities, because it is a principal repayment component, whereas the interest expense is going to be reported under the operating, or of course it can be under financing as well. IFRS gives you that option. Now I know you might be feeling a little bit confused, so we have an example, right? And this is from your curriculum, and this is going to make everything come together. So let's say We are looking at it from the lessee's perspective, and this is based on IFRS. So the company is being offered the following terms. It's a 5-year lease and interest rate is 10%. Annual lease payment is 100,000. So the present value for that is 379079, and it will be amortized over a 5-year lease term on a straight line basis. And the company reports under IFRS. So what would be the impact of this lease on the company's balance sheet at the beginning of the year? So you know that it will record a right of use of the asset and it will record a lease liability. And how much do you think that amount will be? Yes, you are absolutely right. It will be equal to the present value of the cash flows. Right? So that's the first step. You record an asset and you record a liability. So that is done. Secondly, income statement during the following year. Now, for this point, you need to calculate, first of all, what is 10% of this, right? Or the liability, same thing, right? What's 10% of that? And that will tell you, well, in the first year it's the same thing, but from the second year, of course, it's going to make a difference. So 10% of the liability, which means 37,907.9, that will be the interest component, right? So that will be the interest expense that we will record. And the remaining part, which is going to be 379079 minus your 37,907.9, which, my friends, is 379,079 minus 37907. 1 second. 379,079 minus 37907. No, hold on. This is, we have to take from the payment of 100,000. So that will be 100,000 minus 37907, which is going to be 62,093. This is your principal repayment for that year, right? But as far as the income statement is concerned, we're going to record that interest expense, right? We need to calculate what is the amortization expense for this period. Now, the amortization expense is going to depend on this asset side, which you're going to amortize over how many years? 5 years, right? Straight line, which means 379,079 divided by 5 years. So 379,079 divided by 5 gives you an equal amount of 75815.8. So this is going to be your amortization expense, 75815.8 each year for the next 5 years. So these two are going to be the impact on your income statement, the interest expense of 37907 and the amortization expense of that much. Now, what will happen the next year after that is, this principal portion is going to go and reduce the lease liability. So your lease liability will become 379,079 minus 62,093. So your lease liability will reduce. It will reduce for the next year and it will become 316,986. And then for the following year, 10% will be applied to that. And what will happen on your asset side is that your amortization of 75815.8 will reduce your asset as well. So 379,079 minus 75815.8. This will become approximately 303,263. And I really want to emphasize on this point that look how the asset and the liability now become different. So this happens in lease accounting for IFRS, and this is what we were just talking about. If I go back to the previous slide where we said that this difference, this divergence can come over time, right? Because the amortization is being done on a straight line basis, right? It will go down faster initially, whereas the principal is going to go down slowly initially. And that is what we see over here, that this is going down slowly and this is going down faster initially. And the reason for that is that because the base is bigger, so 10% of that is bigger. But as the base gets smaller, the 10% of that will become smaller and smaller, and the portion from the fixed 100,000 payment per year, which is the annual lease payment, more percentage of that will go towards the principal, and then later, of course, the principal portion will become bigger. And let me show all of this to you as a separate slide for each of the parts of the solution. So obviously the first one is that you will record a liability and an asset equal to the present value. Then what you do is you calculate 10% of that present value, and that is going to be your interest expense, right? And as far as the amortization expense is concerned, you just have to divide this by 5 and you get that equal amount of amortization which you will book each year. So that gives you your income statement impact, that there will be an interest expense of 31,000. Well, they've asked for year 2. So in year 2, the interest expense is 31,699, right? And the amortization expense for year 2 is going to stay the same. All right. And for your cash flow statement, before I move on to the cash flow, let me just show you how the principal portion is becoming bigger and bigger each following year, right? And how your lease liability is going down. And this is a number that we had just calculated together. Okay, now moving to your cash flow. So the principal payment that you are making each year is going to be shown under financing activities, right? And as far as your interest portion is concerned, IFRS gives you the option of showing it under operating or financing. All right, let us now move to US GAAP. So lessee accounting for US GAAP. As you know, US GAAP is having both different versions for financing lease and operating lease. And we are going to look at both now. So when you're talking about operating lease, what's happening is that you're going to record a lease liability and you're going to record a right of use of an asset, both equal to the present value of the lease payment. So far, the same as IFRS, right? But the difference here is that the amortization amount is exactly equal to the principal portion of the repayment, which means that both your lease liability and your return, your right of use will always equal each other, right? So previously that we looked at the IFRS version where the interest expense is 31,699 and the principal repayment is 68,301, but the amortization we were recording based on that straight line amortization of 75,816, and there was a difference between these two, right? But for lessee accounting, for US GAAP, for operating lease, the principal repayment will decide what you're going to record as the amortization expense. And in this way, your asset and liability will always equal each other. So this is good for operating lease under US GAAP from the lessee's perspective, right? So what's happening on the financial statements? You're recording your lease liability and it will reduce as the principal repayments are done. You're recording the right of use of an asset. It is reported net of accumulated amortization, but that amortization is equal to the principal repayments. Another very major difference. Now this is a major difference. Interest expense and amortization expense are shown as a single operating expense on the income statement. They are not reported separately. Now let me emphasize this again, that on your income statement you have your revenue, you have your cost of sale, then you get your gross profit, and then you have your selling, general and administrative expenses, and then you have your earnings before interest and tax, and then you have your interest. Now in the lessee accounting for IFRS, what did we see? That the interest portion was being recorded separately and the amortization was being recorded separately. But here, that is not the case. Here, you're recording a single operating expense, right? And that's probably going to go all over here. So, equal to the payment that you're making, that will go over here. So, since a larger portion is being recorded as an operating expense, your operating profit is going to get hit more. Versus under IFRS, part of that expense was going as interest expense, so your operating profit would be higher under IFRS. So as an analyst, you need to be aware of this, that if you are analyzing two different companies and they both have operating leases, but one is reporting under US GAAP and the other one is reporting under IFRS, and you're comparing their operating profit, you need to be aware of this, right? And if you're comparing the cash flows as well, then you also have to be aware that in the case of operating lease under US GAAP, that entire lease payment will be shown as an operating cash flow, right? Whereas in IFRS, we were showing the principal repayment as the principal as a financing cash flow. So this is also a major difference, and it affects your ratios, right? So it affects your ratios. Your operating profit is lower. Definitely your EBITDA to total revenues will be lower. Sorry, your assets are higher, but your asset turnover is lower. And why? So let me just slow down and explain this to you. In the case of an operating lease, what happens is that you are recording the same amortization as the principal. Now try to remember that the principal is small initially, right? And it gets larger later. So if you're going to be doing US GAAP based operating lease, then the amortization amount will be smaller. It will be close to 62,000 instead of the 75,000 that we do when we do the straight line amortization, right? So it will be smaller, and therefore your asset will be larger because you're amortizing it slowly initially. So what will happen is that your asset value will be larger, and therefore your asset turnover will be lower because the denominator is higher. Now, cash flow per share, of course, is going to be impacted as well as far as cash flow from operations is concerned, because this entire payment will be going and hitting your cash flow from operations in a negative way. Whereas if it was a finance lease, only the interest portion would go and hit the operating, and the principal repayment would go and hit the financing activities, right? So under US GAAP for operating lease, your cash flow per share will also be lower.